The word is you've got to be open, transparent, and just tell the freaking truth. This is what's going on. Nobody could have foreseen this happening. But at the end of the day, if you're a good operator, you're still going to be able to provide value, return to investors, and get them their principal back. And so that is a real scenario. So every scenario is a little bit different. So far, out of all the buy, refi, and keep, we've done a number of those. We've always been able to return the investor's equity, if not all immediately, within 6 months to a year after the refi event happens.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik, and with me, as always, is John Cohen. How we doing, bud?
We're good. We got no complaints. Went for a nice walk this morning with the baby, and hanging in there. But I know we got a short time frame, so we can jump right into it.
Yeah, for sure. No, we're a little short on time today, so you won't hear anything from us. We're going to bring our guest in. Excited to hear his story. I was on his podcast not too long ago. Wanted to have him on, so excited to have him on. With that being said, Josh, thank you so much for joining us.
Hey, guys. Yeah, thanks so much for having me on, man. I'm excited to be here and share a little bit with your audience.
Fantastic. Why don't you kick us off? Tell everybody a little bit about you, your background and journey, all that great stuff.
Sure. Yeah. I guess we'll start with today. One of the reasons why we're going to run a little short on this podcast is I'm going to look at a 193 unit apartment building. I'm a multifamily syndicator, apartment investor. We own 3,700 units now of apartments. We've raised about $80 million of private capital. And I have a story I think a lot of real estate investors kind of think that might happen for them or kind of aspire to. I started with a desire to get into real estate because I hated my day job as a financial planner. I got into residential real estate with no money, no income, no credit, started doing wholesaling, had a lot of success with that. Then unfortunately in 2011, I was diagnosed with pancreatic cancer, and that changed my life because not only was I really sick and had my surgeon that saved my life, but it really changed my perspective on real estate because I realized wholesaling, as great as it is and as much income as I was making, it all stopped. It all really ceased overnight when I was stuck in my hospital bed and going through this crazy experience. So I started investing more in commercial assets, cash flowing assets. I started a fund. We invested and lent out of a fund for a long time. And then that led me in 2017, 2018 into apartments. And we joint ventured on a bunch. We own or operate a bunch. We raised capital. I mean, we just had a huge team meeting yesterday to cover all of our monthly KPIs. And so we've had this massive evolution from residential to commercial lending and fund management to, owning and operating apartments, which is all we do now. So we're excited that that's our life. It's our lifestyle. It's fantastic. And, it's been an amazing journey for the last 15 years.
Yeah, for sure. I think one thing a lot of people struggle with is making that jump from, the wholesaling, flipping side to commercial and then scaling up into the big stuff. And I'm sure, doing it while you were having health issues as well was pretty, just adding another layer of complexity to it. How are you able to tackle that jump?
Chris, I would say, look, like one step at a time, like one foot in front of the other. I didn't make a clean break from residential to jump into commercial or from residential to jump into apartments. It was that we were primarily doing residential investing. And then it got to the point where we were doing so many flips and so many wholesale deals, but I was really good at raising money because I had this financial planning background and I managed a lot of money in the market, stocks, bonds, mutual funds, retirement plans. I was really good at raising capital for my residential deals. And my investors came to me and said, well, Josh, this is great, but what else do you have? And I thought, well, I don't want to do 30 rehabs a year. I don't want to do 50 rehabs at a time. That's just going to be way too much to handle. So I pooled the money into a fund. So I listened to the market, right? What the market was telling me, what my investors were telling me. And I said, okay, let me create something that I know the market wants, that I know my investors want. Let's put this in a fund structure. let them all invest in a fund, and then we'll lend and invest out of a fund. That was my first step into commercial investing. What happened from there is the next step, Chris, was inside of that fund, we started lending on commercial deals. Small strip centers, apartment buildings, 8plexes, 20 units, 50-unit deals, 34-unit deals. So we had a taste of what it was like to underwrite, originate loans against multifamily deals. This is going all the way back to 2014, 2015. Then it got to the point where our investors continue to say, well, Josh, this is great. Now we're investing in this fund structure, and we've got all this cash flow coming in from all of the interest on all these notes. What else do you have, right? And so I listened again to what the market said, and I thought, well, let me see about equity investments in apartments. I had a couple good friends that were already doing apartments and doing syndications. They were short of capital. They didn't have all the money they needed to fund their deals, so they pinged me. We looked at those deals, we underwrote, we decided to co-GP those, co-sponsor the loans, and raise money. And I thought, okay, this is kind of cool. I'm not the property manager, I'm not the boots on the ground, but I'm a GP. We're raising money, we're sponsoring loans. This is a nice step. And then that grew from doing one deal to the next deal to the next. All of a sudden, we were doing one deal we syndicated was 730 units, a $20 million deal with a $50 million upside, massive value add play. But we bought it at the right time when we were buying deals for like 20,000 a door. Now they're 80,000 a door just because the market's gotten hot. So again, listen to the market. And then it got to the point where a few years ago, we said, look, this apartment, we like the lifestyle, the business of apartment investing. And we started to migrate out of the fund. And then when COVID hit last March, it just exacerbated the fund wind down. We had already planned on winding it down. We started winding it down. And we just decided to fast forward that process, stop making loans. So instead of doing apartments and lending, apartments and fund management, we decided to pair them off and focus just on apartments only. Frankly, my workload has gone down about 90%, and my net worth has gone up significantly, 8 figures significantly over the last couple of years because of the apartments that we're doing. So less work, more income, less work, bigger balance sheet. I feel like we're heading in the right direction. So at the end of the day, though, Chris and John, it's all about kind of listening to the market, listening to what we're passionate about, what we really enjoy doing, and then tackling that one step in front of the other.
So it's funny. I would almost imagine a lot of people would, backtrack, when something happens like COVID, you want to be higher in the capital stack, right? Debt is safer than equity. You said you went the other direction. Why didn't you kind of backtrack and maybe increase the lending you were doing to be a little bit safer in that capital stack as things were uncertain?
Yeah, Chris, a good question. I think, I think I'm smart, but I'm not that smart. And I'll never forget on March 16th, last year, 2020, we were not only lending our own money in the fund, but we were brokering for other lenders, Pier Street, Riverview, Rock, a bunch of different, Lima One. We were brokering for all these companies as well, doing tons of transactions. And we were about to have our biggest year ever, our biggest month ever in March of 2020. And I remember on March 16th in the morning, I woke up and the pricing of loans, let's say, was X. Every hour that day, the pricing of loans was going up by 100 bips. And by the end of the day, nobody was lending anymore on bridge financing. The only game in town after that day was Fannie Mae and Freddie Mac. So it wasn't that we made like this super smart, intelligent decision and thought about it for days or weeks. We listened to the market and we thought, holy crap, nobody else is lending bridge financing now after this day. We're going to stop lending too and just take our chips off the table, sort of pencils down and see what happens. And then it was like the next 10 days, I swear I made 10 years of decisions in 10 days with all the stuff that was going on. And then it just turned where it was like, look, man, as we evaluate where we're going, these apartments over here are holding up really well, even in COVID, even with these eviction moratoriums, even because we invest in B-class apartments, people are still paying their rents. There's very little breakage. We were collecting like 97, 98% of what we were collecting before COVID. And we're like, this is holding up really well. And again, the market's telling us, wow, this is an asset that's got, a real backbone to it. Let's just stick with these, because the lending business was so transactional. And we realized if everyone else is going to shut down because of COVID, we're going to shut down. This could happen again. This is not a business I want to be in and go through this experience a second, a third time down the road. So we listened to the market and we said, all right, we're going to get rid of the fund. We're going to take this $40 million that we manage in our fund, and we're going to just migrate this over into more apartments. And that's what we've been doing.
Gotcha. Love it. No, I think it's a smart move. And I think, a lot of people were worried early on, but kind of tempered out as things went on. Who knows exactly what the reason is, but it was interesting to see. You said something too that I think a lot of people probably perked up and were curious about. You said your net worth and balance sheet, 7-8 figures over the past couple of years versus the debt side. How, that type of money doesn't just appear overnight unless you're structuring things a certain way. So how are you able to, raise that capital, do these deals, owner operate, and also, have that outcome? Are you structuring deals a certain way? What's your strategy there?
Sure. Yeah. So one quick note about the fund business versus apartments, the fund management business is just an income play. And my net worth was based off of a multiple of revenue, right? It's just, you take your earnings before interest, taxes, depreciation, before EBITDA, and the lending business is worth a multiple of your earnings. The lending business doesn't really own assets, right? It's just income times a certain multiple. That's how it's valued. So my net worth was based off of my equity in that business. Multifamily apartments, whether it's self-storage, mobile home parks, other things, you can value your net worth based off of the true equity, the difference between your debt and the valuation, right? And you get the cash flow and you get the depreciation and all these other things. So that was the difference in my mind, why apartments made more sense. So that's the first thing. Second thing is that over the last couple of years, we've done a combination of owner operate and then co-GP, co-syndicate, right? Co-sponsor. And so because our background was in the fund management business and raising capital and deploying capital, we had an abundance of money that we had to deploy and pivot and move. So we were able to do tons of deals. I mean, this 3,800, 3,700 units of apartments we were able to build over the last really 4 or 5 years. It's a $300 million portfolio. I don't own all of it, but we own a big chunk of it, right? And so we, with any commercial deal, you syndicate it. The LPs own some, the GPs own some. Our model, to get to the point about the model, is we syndicate deals. We typically give up about 20% of the deal. We like to structure deals where we're giving our investors an 8 to 10% pref, heavy value add construction, like $500,000, $1 million, $2 million, and in some cases, $3-4 million worth of capital improvements. We force the appreciation in a very short period of time, usually 2 years or less, by doing a significant capital improvement. And then the goal is season that deal for then about 6 months and then refi. And in that scenario, hopefully refinance some or all, typically all of our investors' capital back. And because our investors got an 8 to 10% pref up front, and now they've got their capital back, their principal back within, let's say, 3 years or less, they're happy to then own less of the deal because we return their capital faster. If I was doing a 5 or a 7 year syndication, then I probably would have to give up more of the equity and take less for us. So in that scenario, that's allowed us to really increase our net worth significant amount by retaining, in most cases, 70 to 80 to 85% of deals. Now, one more thing about structure. So because again, we're good at raising money, we're really good at working with investors, paying them a great return. But when we do a deal that's under 5 million, we give up no equity. We pay our investors a 10% pref and a 1% kicker at the refi. So we give up no equity. So on a small deal, let's say we're all into it for 3 million, 3.5, and it pencils out at 5 or 5.5 when we're done with it. We're able to retain 100% of that equity and not give any of it up to investors because they're getting a 10% return and then that 1% kicker. We've been able to raise about $3, $4, $5 million just in that structure. So we're able to retain a big piece of the equity, which obviously leads to a larger balance sheet. So on the larger deals, we give up equity about 20 to 25%. On the smaller deals, we give up no equity and just pay people a pref return plus a kicker. That's worked well for us. Now, the only way that works, Chris, is when you have an abundance of capital and you can kind of almost not negotiate, but work with your investors, right? To tell them, look, this is the deal I have today. All I can pay you is this 10% plus 1%. Because it's a smaller deal, there's less equity. We're not going to share the equity. And we've been successful at doing that too. So those are some different structures what we've used.
Gotcha. You're on mute, John.
When has that been an easier conversation because of the prior fund being a debt structured fund where more or less people were okay with the debt component?
Oh, great question. I think yes. I think that's definitely helped because in that fund, people were earning a variable return, but it was all based off of the interest off of the debt, right? So the fund had like hundreds and hundreds of loans in it, all earning interest, private money and hard money loans. And they were getting about a 9 to 12% annualized return. And so pivoting them out of that to these other smaller apartments, definitely, I think that's helped. That was kind of their expectation. So they're okay with it. The other thing is just, again, being in a position where in my business, I'm the majority owner and CEO, but I focus mostly on raising money, marketing, sales, acquisitions, but on raising money. I've got one partner that focuses on our CapEx, and I have another partner that focuses on our property management. They're minority owners in our business. Because we're always raising money, we've got usually when we do a raise, we've got way more money than we need. So I can work with investors and say, look, we're gonna raise $3 million, but I know I can go get $6 million. So if they ask me, well, how come there's no equity in this one? Or how come the return is lower? It's because I've got an abundance of demand and a limited amount of supply. So when that works in my favor, I can offer a little bit less to investors and still fill up my syndication. If I'm the opposite, where I'm struggling to raise money, then I've got to probably give up more equity, you know what I mean, in order to get people interested, because it's the opposite scenario where maybe I'm raising 3 million and I've only been successful at raising $1 million, $1.5 million. Now I'm scrambling to raise capital. And so I think in our business, it works well for us because I've got the three of us as partners that me, again, I'm going to look at a deal here in 20 minutes. I look for deals and I raise money. And then the back end of the business, CapEx, property management is handled by my partners. But because we're always raising money, we don't have to give up as much because our investors are like, hey, I know I want to invest with Josh and his team. I know they're good operators. I know my money's going to be in good shape. So I'm okay if I get a lower return because I want to invest with Josh. See what I'm saying? I'm not really competing with like crowdfunding platforms and all the guys you see on Facebook and all the guys that are trying to syndicate their deals through Facebook ads. We go way deep, way long with raising money and constantly being on the phone with investors instead of just raising money when there's a need for money. And that's allowed us to offer less equity.
Gotcha. So you find you don't hear pushback of like, I would say the typical syndication structure that we hear is, some sort of preferred return and then like a 70-30 split over that where, the LP is keeping 70%, the GP is keeping 30%. So almost flipped opposite.
Right.
There's an abundance of offerings out there that are in somewhat similar. Maybe it's 50-50. You don't feel like you lose people when you have that conversation to other syndication groups, other funds, CrowdStreet, crowdfunding platforms, anything like that?
The answer is I always get that question. I always am fighting against it. And guys that understand cash on cash return, internal rate of return, to them, once they understand the return of principal versus a longer syndication. So like if somebody's offering a 70-30 split, meaning the LPs get 70 and we get 30, the GPs get 30, and they're also going to return capital in 3 years, then I can't win that argument typically. Like the numbers just don't work in my favor. But what most people are doing is they're doing a longer term, more of an organic turn. They maybe have a big CapEx budget, but it's going to take 2 to 4 years with a plan to sell in 7 years. Mm-hmm. I'm much more focused on deals in the Midwest where we can buy them at a bigger discount. Properties that need some more value add, but still stable, 80-90% occupied. Mm-hmm. And in that scenario, because my goal is to return capital faster, then they're willing to flip the LP GP equity. So it's more 70% to us or 80% to us and 20-30% to LPs. It's all about how fast you can return equity. If you can return equity quicker, you offer less. If it's going to take you 5 to 7 years, you have to do the reverse way. I'm fine with both. I don't have a problem with the 70-30 splits with LPs getting 70%. But I do think GPs are shortcutting themselves, because I talk to a lot of GPs. I have my own podcast. We're constantly talking to guys. I do feel like they're just offering that because that's the norm. And they don't know that they could offer more of the opposite and still provide a great return, and people will still buy that. I think it's the norm in the industry to give up 70%. So that's what everybody does, not because they have to. It's a little bit more of a fight, a little bit more of a negotiation, a little bit more convincing for investors. But we've done 13 syndications that way, all with us getting 70 to 80% of the deal.
Will you also, because I know you said, the 8 or 10% preferred, will you raise extra equity to pay people the preferred return through, or do you find deals that are returning that percent, day one, even while doing these, heavy capital deals, which will probably even, lower occupancy a little bit if you've got to get in and redo units and things like that?
Yeah, it's a mix, Chris. Great question. So the answer is yes. We've done deals where they're just a wash for 3 years, where once we have the income coming in, minus expenses, minus debt service, minus pref payments, it's a wash. We make no money, right? So we've done a lot of those. We've done deals where we had to overraise because once you factor in the expenses, debt service, and pref payments, it cash burns negative. We've done a few of those deals. And then there's other deals we've done where there's just enough cash flow to have a positive return, a positive cash flow on day one after expenses, debt service, and pref payments. I would say most of the deals we do are in that middle category where it's kind of a wash, where we're really not making a lot of money in the first year to 2 years, maybe 30 months, because there's just enough cash flow to pay all those expenses. And we take a small acquisition fee, so that's how we make a little bit of money up front. It's not big. It's usually 2% or 3% possibly, depending on the deal. So it's small, but it's a little bit of income, but it pays all the bills, and we're investing for the long haul. So I know after 30 months, we're going to refi, and we're going to keep a big piece of the equity. I'm willing to make that short-term sacrifice to keep more long-term.
What type of stress test from like an investor's perspective, like, interest rates going up or cap rates going up or missing your numbers, if you can't get all the principal out when you think you should, what is the stress test there, or how do you explain that to investors if it doesn't work?
Yeah, it's a great question. We actually got one right now. I'll give you an example. Like I got a 164 unit that we bought. In August, it'll be 2 years ago. Bought it for 9.2. We put about $400,000 into it. So it was not a huge CapEx play, but rents were really low compared to market value. We wanted to get a $14.2 million valuation. Right in the middle of COVID, back in October. So this is just about 15 months after we bought it. We got a new appraisal at 13.3, right? So we were able to bump rents even in the middle of COVID, execute our CapEx plan in the middle of COVID, even though some people didn't even want us in their unit because people were obviously very protective because of COVID. And we thought the appraiser was super conservative. He actually took our financials, but he actually grossed up the expenses and grossed down the income, even though that wasn't what was actually happening. So we turned over real financials. He then finagled the financials, turned them into Fannie Mae. So we've been fighting now 6 months. This appraisal process has been going on since October. And just last week, we submitted some additional documentation to beef up the appraisal an extra $900,000. We basically said back to Fannie and said, look, this appraiser was grossly conservative in the middle of COVID back in October, grossed down our income, grossed up our expenses. Now, if you look at our T6 for the last 6 months, we're actually performing even better than we were back in October. And so what we've been having now, to answer your question, John, is we've been having this conversation with investors to say, look, if this $13.3 million valuation sticks, they're also giving us a slightly lower loan to value. The $2.2 million that we raised of equity, we're only going to be able to return about 60% of it, where we had originally told investors we're going to return 100% of your equity. We're only going to be able to return 60% of it. But here's what we're going to do. Part of the reason why we can only return 60% is because the lender is requiring a full year of principal and interest reserve. So they're keeping like 900 grand or 700 grand in their reserve. Well, that money has to get released within 12 months. So we're going to get the money. We just might not get it now. So the conversation with these investors has been, look, whatever we can't return, the rest of it will stay in the deal. We'll continue to earn a pref return. And once we get the principal and interest release, we'll release the money back to you. That will return the rest of your principal. And by the way, we're also refining into a 3-year interest-only loan. So the 3-year IO loan, instead of our cash flow being around $240,000, our cash flow is going to be $370,000. So we're going to take the remaining part of that cash flow and, again, return investors' equity. So instead of returning it all now, we've had to have the conversation with these investors and say, look, it might come in 3 parts. Some of it now, some of it from cash flow, and some of it from the return of the principal and interest reserve. But look, you're still going to have all of your equity back within about 30 months. Instead of 18 months or 22 months, it's going to be about 30 months. We're going to take this apartment from a $9.2 million value we bought it at to a $14.3 million value. And you're still going to get all your money back within 30 months, and you're going to earn a pref return, and then you're going to get cash flow in perpetuity and equity in perpetuity with no money in the deal. So that's a real conversation that we've had to have with investors, really, just this past 6 months, because the lender keeps saying, yeah, we think we're going to be able to get to the closing table in 2 weeks. I've been telling investors now for 6 months, we're going to get to the closing table in 2 weeks. We're going to get to the closing table in 3 weeks, 4 weeks. So I think in this environment with COVID, John, I think it's a super fair question, but I think everybody, general partners, limited partners, the word is you've got to be open, transparent, and just tell the freaking truth. This is what's going on. Nobody could have foreseen this happening. But at the end of the day, if you're a good operator, you're still going to be able to provide value, return to investors, and get them their principal back. And so that is a real scenario. So every scenario is a little bit different. So far, out of all the buy, refi, and keep, we've done a number of those. We've always been able to return the investors' equity, if not all immediately, within 6 months to a year after the refi event happens. So then investors are thrilled because they're getting cash flow forever with no money in the deal. So I hope that answers your question.
Yeah, no, I understand that because we have a deal that's an opportunity zone that we've been refinancing since December of last year. And I feel like on a monthly basis, I keep telling people, it's close, but, it's the same thing. It's, the banks just have, they have you by the balls, for lack of a better way of putting it, for the last couple of months. So I hear that.
Sure.
Are investors getting the benefit of the tax side, or are they still just getting that pref as a structured, pref equity? But is it really equity, or is it more like debt to them?
It's equity. It's equity. They're still getting a K1. It's still a partnership. You bet.
No, I love being different, right? That's sort of how we built our whole business. Everyone's zigging and you want to zag. And you're right. You won't win the battle with someone retaining 70%, even if they get their equity back or not. But when you can shift people's mindset to say, hey, this is how we do it differently, and the supply and demand's in your favor, I think it's fantastic. I mean, anyone that's able to do it, there's a level, principal protection and principal getting back is very important, and people are willing to sacrifice a lot understanding that. So I give you all the credit in the world for doing it.
I think the other thing too, you asked earlier about how are we stressing the deal. I think in this environment, everyone's talking about inflation, and then there was a lot of inflation talk, and then now we're talking about inflation, not such a big deal. I think it's going to be a conversation really for another year that's going to be going on. So I think you got to look at cap rates, going up at least 25 to 50 bips. I think you got to look at interest rates going up as much as 50 bips to a full 100 bips when you're refinancing and stressing the deal in that way. Look, to me, doing apartment deals and syndications and value add, to me, the number one opportunity, the number one risk is in the CapEx. You gotta have the team that can execute on the CapEx and do it in a way to work around your existing tenants and residents that are living there, and do value add improvements that people really want, and do them in a timely way, on time and on budget. To me, that's the biggest risk in a deal, and it's the biggest upside. Because if I can do that, even if my numbers when I refi don't work out as well, the bank changes what the bank changes, interest rates go up, cap rates go up, I can't control that. right? I could stress it. I could tell my investors that I stressed it. I can underwrite it and stress it. But at the end of the day, I can't control what happens 24 months from now, right? It has to be within this box, this silo that's still going to work for us and work for our investors. But if it's not, it's out of my hands. I'm not Nostradamus. I can't predict everything. But what I can control is what happens at that property every day. I can control the property management, the leasing, the lease ups, the evictions, and the CapEx. So I feel like I can still win, even if the market doesn't work in our favor. I got to be able to tell investors that I did what I could do. I did my part. I did the part that I could control. I did it, and I did it well. Everything else that the lender's talking about, interest rates, cap rates, loan to values, I don't control that. Nobody else does either. So let's just be honest with investors. Control what you can control. Do an unbelievable job of what you can control. And then stress deals as much as you can. And then look, the market's the market. Things are going to change. It's out of everybody's control.
Mm-hmm. So then how do you have the conversation with investors? I know we're coming up on time. We'll wrap it quick. Last question. Let's say in the scenario that market conditions, whatever, you can only return 50% in 3 years. Then is there any sort of, change in the structure? Like how would you handle that scenario in a world where that did happen?
I think I probably would use like the deal I talked about, Chris. I would give up again, most or all of the cash flow after the refi. I would try to, first of all, go into an interest-only loan if I could, if the lender would approve an interest-only loan, because that's going to generate about 50% to 75% more cash flow. I could use that cash flow to return investors' equity. So that's the first thing I would do. The second thing I would do is, if it's going to be a long time until I can return all the investors' equity, you may be able to, one thing that we've considered and talked about, we haven't had to do this yet, is to actually bring in debt to refi out the equity, bringing in like some unsecured private lender notes into the deal, right? Unsecured. Now, so that's tricky because investors sometimes want their notes secured, but I've got investors that trust us that would go unsecured. So let's say I've got 400 grand that I can't return to investors. We've talked about this. I haven't had to do it yet, but could we bring in $400,000 of notes, debt, unsecured, return then the remaining investors' equity, and then just pay those investors on their unsecured notes? That's an option. So extra cash flow from interest only, bringing in some unsecured notes to pay those people off so they're out of the deal. That's another option. And then frankly, keep doing deals, right? We've also talked about, again, haven't had to do this yet, but if we got to the point where investors really were not happy, we really couldn't return enough, and it was going to be another couple years until we could return all their equity, shit, man, just give them free equity in your next deal. Like give them a little something so that they're like, okay, this didn't work out perfect. And again, we're in the middle of COVID still. I know it's dissipating and things are getting better, but we've been operating in an incredibly difficult environment for the last really 15 months. I think everybody's got to have a little bit of a pass or a concession for that environment. If you can't return it now, hey man, look, I'll give you a couple extra points on my next deal. You know what I mean? Try to negotiate a deal where you get more equity so then you can give up a little equity to your previous investors. So there's a couple of options there that I've considered that we've thought through in case that scenario happened.
Gotcha. Love it. I know we're up on time. So Josh, I really appreciate you hopping on and, talking to us about all this stuff. So people want to learn more about you, follow, connect, all the great stuff. Where can they do it? Yeah, just go to our main website, freelandventures.com. There you'll see everything about our portfolio, our case studies, our investment opportunities, books that we have, Facebook groups, YouTube channel, blah, blah, blah. Just go check it all out at freelandventures.com. All right, perfect, guys. Definitely go check it out. Definitely go check Josh out and his team. But thank you, everybody, so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that would get a tremendous amount of value from this episode. Josh, once again, thank you so much for coming on, man. This is great. Absolutely. Chris, John, thanks for having me on. I've really had a great time.
Thank you.